Have you ever looked at a market report, seen it described as, absolutely flat, and just wondered what that really means? Is the market just stuck? Or is there actually a whole lot happening under that seemingly calm surface? Today, we're doing a deep dive into this really fascinating post-market analysis report. It's from July 7th, 2025, founded on the Market Chats channel, a great piece of insight there. We're going to unpack market consolidation and figure out what was truly going on.
That's exactly right. I mean, the headline numbers might suggest almost no movement, but the truth is, when you look closer at this report, you see significant shifts, some surprising winners, and actually some important clues about where things might be headed. So our mission really is to pull out the most useful bits of info from this post-market analysis for you, helping you understand what's actually unfolding, even when, on the surface, it looks like, well, nothing much.
Okay, let's get right into it then. The report kicks off with this really striking observation of the Nifty. Nifty future up just 1 point and Nifty spot barely zero point 0.3 points. The analyst literally said absolutely flat for the day. So for people trying to make sense of this, what does that kind of sideways movement tell us? And maybe more fundamentally, what exactly is market consolidation? Why should we, pay attention to it?
Yeah, well, that kind of flatness, it's a pretty clear sign of market consolidation. You can think of it almost like a coiled spring. The market isn't really making a strong move up or down. It's sort of pausing, maybe building up some tension. It's often a period of indecision, right? Like a tug of war where neither the buyers nor the sellers can really gain the upper hand. Basically, consolidation just means the market's stuck trading in a pretty tight price range. It often happens before a more significant breakout. And the analyst in this post-market analysis, they explicitly said they expect things to stay sideways, probably until Thursday. Any real action, they think, probably won't happen until Friday, specifically after the TCS results come out. So for now, it's kind of a waiting game for that next big piece of data. And that waiting itself can be revealing.
That makes sense. The coiled spring idea, that really helps visualize it. So it's not just boring, it's potential energy building up. Okay, and this leads to something that really jumped out at me from the report. Amidst all this, flatness, the analyst sounds almost happy, especially for option traders. Calls it hopefully the golden period of comeback for option writers. Now, why would option writers be so pleased when the market is barely moving? That feels kind of counterintuitive, doesn't it?
It absolutely can seem that way at first glance. But this golden period, it connects directly to some pretty important market mechanics. See, the report points out that SEBI, that's India's market regulator, has been taking severe action against people like Jane Street. Now, Jane Street, for anyone unfamiliar, they're a huge global trading firm, big into quantitative trading, high-frequency stuff, market making. When firms like that are less active or, facing restrictions, you tend to see less aggressive, super fast arbitrage and generally less market volatility overall. Think of it maybe like Jane Street was the Formula One car on the track, always making super quick moves. With them less dominant, maybe the market feels a bit more like a steady drive. Slower, perhaps, but safer for some.
Okay, so less of that high-speed trading means things calm down a bit, less volatility. But how does that directly make it a golden period for option writers?
Great question. So lower volatility usually means lower premiums for options contracts. And option writers, the sellers, they make money mainly from something called time decay, or theta. It's a bit like selling insurance. Every day that passes without an incident, the value of that policy slowly decreases for the person who bought it. It's similar with options. As time ticks by, especially if the underlying asset, say, Nifty, isn't moving much, the time value part of the option price erodes. That erosion benefits the person who sold the option and collected the premium upfront. So in a flat, consolidating, less volatile market, premiums start lower and they decay nicely when the market stays put. It's basically the ideal setup for writers. The analyst even made that little joke, right? No Jane Street, no fun in the market, meaning for some traders, the crazy action is gone. But yeah, for option writers, it's clearly a good time. It just shows how regulatory moves can really shift who benefits in the market.
That insurance analogy really clicks for explaining time decay. Fantastic insight from this post-market analysis.
Okay, let's maybe switch gears a bit and look at specific sectors. The report mentioned Bank Nifty has been, quote, underperforming recently. We saw that pattern, right? Stuck between 54,000 and 56,000 for ages. Then it popped to 57,000 after that RBI policy news. And now it seems to be just consolidating again, right around 57,000. What kind of opportunities does that create? How would someone actually, trade that.
Yeah, and if we link that back to the whole consolidation theme we were just talking about, for traders who recognize these patterns, something like a short straddle right at that 57,000 level, that probably would have been good money, as the report said over the last few weeks. A short straddle is it's an option strategy specifically designed to profit from low volatility. You sell both a call option and a put option at the same strike price, 57,000 in this case, and with the same expiration date. You collect the premiums for selling both. The idea, your goal, is for Bank Nifty to stay really close to 57,000 until those options expire. If it stays in a tight range around that strike, both the calls and puts expire worthless or close to it, and you keep the premiums you collected. It's a classic way to trade consolidation, betting against a big move rather than for one.
Right. So while some folks are waiting for a breakout, others are actively making money from the market, just staying put. That's clever. But okay, the biggest surprise for me reading this post-market analysis was definitely the FMCG index. It apparently shot up more than 1% today. And almost all the FMCG stocks higher. And the analysts really stressed this is happening after a very, very long time. What's the deal there? Why is FMCG suddenly surging now after being down for so long?
Yeah, that FMCG move really does make you ask, why now? What's changed? And the context here is pretty crucial. The FMCG index has actually been, well, the worst performing index among the major ones for quite a while. A lot of those stocks are down, 20, 25% from their peaks. They've been under pressure pretty much since last October. So that's, 9 months? So this sudden jump could mean, as the analysts suggest, that some people are seeing value in these beaten down stocks. Maybe they're expecting good results from the sector in the earnings season that's coming up. It definitely feels like a sign of revival, like something's finally waking up there. But, and this is important, the analyst rightly cautions we need to see if it continues. Watch the next few trading sessions. Is it real or just a blip? It's definitely hopeful for a sector that's struggled for, almost a year now, especially when, as the report notes, other sectors like IT and auto are still sort of struggling. FMCG really did stand out.
Yeah, it's always interesting when a sector that's been out of favor suddenly gets attention. Shows how money moves around. Okay, zooming out again to the broader market picture. The post-market analysis mentioned India VIX was slightly higher, which is interesting, right? Because the market itself was flat. But then long-term options, both calls and puts, apparently collapsed. How do we read that? Sounds like a mixed signal. A big contradictory.
It does seem contradictory on the surface, doesn't it? But it tells a subtle story. A slightly higher VIX, even when the market's consolidating, suggests that, well, despite the current calm, there's an underlying expectation of a significant move coming soon. Like that coiled spring we talked about, it can't stay wound forever. A rising VIX usually hints at building uncertainty or anticipation of a breakout, could be up or down, but then the collapse in long-term options tells a different part of the story. That suggests that while a near-term move might be expected, the market isn't pricing in massive sustained volatility further out, like months down the road. So lower expected volatility over the long haul means lower premiums for those longer-dated options. It's complex, right? It hints maybe at an impending breakout soon, but perhaps not the start of a prolonged period of wild swings.
Okay, so the spring might uncoil soon, but maybe not bounce around wildly afterwards.
Interesting. So if a breakout is potentially coming, what does the report suggest might be the trigger? The last big move came after that RBI policy news. What's the analyst predicting this time? What could be the catalyst? Well, the post-market analysis flags a few key things to watch. Corporate results are definitely high on the list. TCS results expected Friday seem like a major potential trigger. TCS is huge, right? It often sets the mood for the whole IT sector, which impacts the broader market. Beyond TCS, results from other big names like ITC could matter too, though they tend to report later in the season, so maybe less immediate impact. IndusInd Bank might report earlier, potentially giving a spark to the banking space. But it's not just about earnings. The analyst also points to, bigger picture stuff, geopolitics. A major move could easily be triggered by news about, say, a tariff agreement between India and US, or any other significant global tariff-related good news. Things like that can really shift investor sentiment quickly, impacting trade outlooks, corporate profits, the whole economy. So yeah, the trigger could really come from multiple places, not just company reports.
And that leads to another fascinating detail, actually, from the FII and DII data last Friday. The report highlighted that both foreign institutional investors and domestic institutional investors were net sellers in cash market, which apparently happened after a long time. What's the significance of both big players selling at the same time? And why doesn't the market tank?
Yes, that's a very, very significant thing, as the analyst termed it, and rightly so. I mean, think about it. FIIs and DIIs, they're the heavyweights, right? The big institutions moving huge amounts of capital, Usually, if both groups are selling heavily on the same day, you'd expect the market to take a hit. It's a lot of selling pressure. And yet, despite both being net sellers and with U.S. futures apparently lower too, suggesting maybe a negative global backdrop, the Indian market did not fall. It just consolidated, stayed flat. That points to some surprising underlying strength, wouldn't you say? A certain resilience. It suggests that even with all that institutional selling, there was enough buying demand somewhere else, maybe retail investors, maybe other funds, maybe short covering, to just absorb it all. It prevented a decline. It's like the market has this solid foundation right now, holding things up even under pressure, almost like it's shrugging off the selling. That's a really powerful picture of resilience. Makes that flatness feel less like stagnation and more like stubborn strength. So to kind of bring this all together for you listening, the market might look calm, maybe even boring on the surface. But underneath, as this excellent post-market analysis from Market Chats shows us, it's really a game of consolidation. It's a time where certain players, like those option writers, are having their moment, their golden period. And we're seeing hints, like with FMCG, of potential comebacks in sectors that have been down for a long time. The analysts' overall take seems to be, expect more consolidation probably until those TCS results hit.
Absolutely. And maybe that leaves you with a thought to consider. Given this hidden strength we just discussed, the market holding up despite FII and DII selling, and with that rising VIX hinting a breakout is coming eventually, what specific factor do you think will actually be the main trigger for the market's next significant move, and why?
Okay.
Definitely worth keeping a close eye on those upcoming earnings, especially TCS, and any whispers on the global trade front. There's always more to unpack in these market dynamics.